Time seems to extend, so you do end up seemingly on Zoom for longer than you'd potentially have a normal meeting, wouldn't you?
For sure, yeah. No, you have got to stick a time to it and try and stick to it, which is what we're going to do this evening. We'll try and keep it to this evening, this afternoon, this morning, depending on where everyone is. 45 minutes to an hour, depending on the questions we've got. But we've got.
Where are people calling in from typically?
We've got all over. You know, we've got. I'll say some people in the UK, not including you guys. We've got the Middle East, people calling in from Qatar, and then probably the bulk of people over here in Singapore, Hong Kong. So good morning, good afternoon, good evening to everyone, wherever you may be. And then we've got, just for you guys, just so you know, we've got, I'd say probably about 20 clients joining, and then 15, 20 people that aren't clients. So we'll just bear that in mind. But yeah, hello everyone that's tuned in. Let's crack on. Okay, just as a starter, you know, as you're all aware, the COVID situation's making meeting face to face and communication very difficult with clients. You know, that's something we like to do as APW, is meet people face to face and do things that way. So what we're going to be trying to do over the next few months, however long it takes, is run these weekly webinars with developers, with different product providers. Sometimes it'll just be us just talking about, you know, the current market, mortgages, tax, whatever it may be, but we'll try and do these on a weekly basis just to sort of keep in touch with people. So that's sort of the thinking to everyone listening behind this evening. Today, as you all know, we've got Joe Billingham and David Yelloly from Prosperity having a chat with us and answering some questions. Joe, David, do you want to just say hello again?
Hello.
Excellent. Hi there. Thank you for joining us today.
And Joe, just for those people that are not clients and that have not met you before or not come across Prosperity before, could you just give us very briefly just a quick overview on Prosperity and yourself? Sure.
We're Birmingham-based developers. Take a national approach, really, with PDR, which is office conversions into residential or sort of new build. We do a mix of the two. So we're currently developing from Southend to just outside of Liverpool in Birkenhead, but with a focus in the West Midlands and Birmingham city centre particularly. So we've currently got 36 schemes within our portfolios, from sort of delivered through to current developments that we're working on. Delivered over 1,200 PDR units, which makes us one of the largest in the UK. And we're currently Birmingham's second largest homegrown developer. Within the group, we have Prosperity Wealth, which is our kind of interaction point with wealth with clients, and Lamont, which is a lettings and management business, and MAB Birmingham, which is a regulated mortgage business. The idea there is that we offer a holistic offering, so we can sort of take clients from sort of early reservation, talking to them about their objectives and goals, what they're looking to achieve through property. And then throughout the process, we can facilitate them both from a funding and lettings and management perspective.
Cool, excellent. Thank you very much. And David, what do you do for Prosperity?
Right. Okay. Joe was obviously the founder of the business, and Joe and I have known each other for many years. And I come from a financial services background. And when I sold my business, Joe offered me the opportunity of a lifetime to come and work with him, which I took with open arms. So very much running alongside property. The experience that I gathered before in terms of investments and funds and pensions means that I've got a good general knowledge of the whole gambit of financial planning, and can see the merits of property, bricks and mortar investment. And that all happened about 6 years ago, and hindsight's a great thing, but I wish I'd made the move much earlier. And my role really is to act as a conduit between Joe and our clientele and all of our introducers, and just try to manage the relationship they have with their clients. be perhaps a bit more hands-on than Joe can be, because I'm more able to travel around the globe, COVID allowing, and seminars wherever anyone wants us to, and actually have direct contact with clients as and when it's appropriate.
Very good. Thank you very much. Okay, good stuff. And for those of you that are tuned in that don't know me, my name's Callum Williamson, and I sort of help look after APW clients all over the world, primarily in the Middle East, Hong Kong, Singapore, Asia. Okay, awesome. So Joe, David, what we've been doing this week is speaking to existing clients of ours and asking questions, finding out what they'd like to hear from you guys, things like that. Given the current situation, there's been a couple of themes and a couple of very common questions we've been getting, as you can imagine. We've sort of broken it down into 4 themes or areas that people are asking questions on. So to give you a heads up on those, it's trends, what's going to be happening in the property market immediately, over the next 3 months with COVID going on, and then how's that going to impact things 6 months, a year, and perhaps further down the line. That's number 1, so general property market trends. Number 2 would be the direct impact of COVID, the corona. Firstly, again, on the markets and property markets, and then secondly on prosperity as a business and people's properties with you. That's 1, 2, and then 3. A lot of questions raised around people's specific properties. Can we get updates on those? What's going on? Where are we with things? So we'll go through those at the end, and then sort of finally, although it's a bit of a strange time and there's lots of different stuff going on, where are the opportunities? Where are the growth areas? What are you guys doing to find those areas? And if people want to get involved in new opportunities, ideas, where are the places to be doing it? So those are the 4 main areas. So if we just sort of start working our way through them, what we'll do, guys, is everyone listening, we'll try and cover off as many questions as possible throughout that, and then if we haven't answered your questions, we'll open up a Q&A session at the end, and we can do questions then. And if we have too many questions and we don't get around to your questions, then what we can do is book in for one-to-one calls or whatever it may be tomorrow or over the weekend, whenever you're free. So let's crack on. Let's get going. Joe, we'll start with you, if that's okay. Trends, the property market in general. Where do you see things going now with COVID, and where do you see things going once we're through it on the other side? Are we going into a positive phase of growth of property, or where are we?
Okay. Well, I think first and foremost, when we talk about the property market, there's a stagnation ultimately. So there's really at the moment we're seeing things on hold. So from sort of through a state agency, obviously estate agents are currently closed in the UK. There are challenges with lenders, i.e. them processing mortgage cases and being able to continue as business as normal. Solicitors, as you can imagine, they're sort of working from home, so that's a challenging time for them. And generally, obviously, the appetite for acquiring new property at a time like this, when people have got other things to focus on. So all of that means that there's a stagnation effect, really. But it's not. I think there's a big difference between where we may have been before, with kind of slowdowns in markets, whereby there's a fundamental challenge with capital markets or supply and demands. But this is very different. So this is a short-term scenario. I think if you look at a lot of the economists, they're all aligned in their thinking that there'll be a short, sharp contraction over the summer, and then we'll get a sort of a rebounce kind of coming out of the late autumn into sort of Q3, Q4. So I think ultimately there's a big difference between against sort of property values coming off, and sort of we're not seeing any sort of value changes. It's just a pure stagnation. I think it's ultimately we've kind of stopped the treadmill for a while. But across the board, obviously, there's lots of factors in the property market functioning properly, and a lot of those components just aren't able to function properly at the moment, which means that everything's just on a pause, really. But I think another point is that when you made the reference there, when you talked about it generally in the property market, and I think we need to be mindful of the fact that when we talk about the property market and the headline that you might see in the media is very much related to the residential owner-occupier market. And there are different pools and different segments within the property market as a whole. So the rental market it remains very, very strong. Again, it's on pause because people that either were moving out or were moving in potentially are having to hold back and sort of stay where they are until this has obviously cleared. And then I think there's an argument that that'll all come back relatively quickly. I think the point is that not to get sort of too focused on the residential market if you're looking for an investment property, because the fundamentals are quite different. Yes, people are struggling to move into new homes, and obviously then that's because of the pause, but ultimately I think the residential market from a lettings perspective and from an investment perspective, all those fundamentals remain sound.
Great. Okay, thank you.
Was there a third part to the question?
No, that was it. It was just a very open-ended general question. I think you did a fantastic job. Thank you. David, have you got anything to add? Was anything you add to that?
I think obviously we're going through that overused, unprecedented time, aren't we? But it is. I think for anybody who's less than 60, certainly we've not seen anything like this, and it's. If we're completely frank about it, we're all a little bit bemused by what's going on, and so there's no one who really is going to be clever enough to paint the picture of what everything is going to look like in the next 2 or 3 months. And of course, that's the reason that the equity markets have been so badly affected so quickly. And I think one of the distinct advantages of property over equity is that it is illiquid, and in these circumstances. You don't see a huge markdown in values because there is just this difficulty in disposing of it, and so people don't get involved very often anyway in fire sales. They're not going to go and sell a property at a knockdown price, whereas you might do that with a Yahoo share or a Google share. Just get out and sell it. So that's a major advantage for property. And as Joe says, the fundamentals in the UK, particularly for residential property, particularly in city centre locations, are still there. There's still an undersupply of suitable property for people who want to work in the city centres. And I think our perception at the moment, and of course some of it is born out of hope and optimism, which is a universal trend in most humans, I think, but is that we'll get through this pretty quickly, and I think when we do, the market, particularly in property, will quickly get back to where it was. Despite the fact that all these this virus is spreading so quickly around the world, there's no doubt that HS2 is still currently being built. And HSBC are expanding their workforce in Birmingham, and Deutsche Bank as well. And there's a chronic shortage of suitable property for the people that are going to work there. So I think we have to, against that backdrop, we have to assume that's going to be the case for the foreseeable future.
Great. Okay. Thanks. So we're perhaps looking at a shorter term slowdown as people can't actually get out of their houses and view properties and all that sort of stuff. But once, say, lockdown restrictions are lifted, then we'll be back to normal.
Yeah, and that's an interesting point you make. The very nature of what we're involved in primarily, which is selling products off plan, is less affected than selling something that's actually complete and just sitting there ready to view. We have always marketed our sites in the early part of their development as a project to aspire to invest in, and actually the reality is in 2 years' time this will be all behind us, I'm quite sure. And so the net effect of something happening in April 2020 on a property being completed in 2022 is pretty academic, I think. And so somebody can invest today in a property that's going to be completed in 2 years hence, and probably have a pretty strong confidence that it will actually come to fruition.
Great, thank you. That leads quite nicely into our next question, or the questions we're being asked by people, which is, how is this going to impact on bills, people's bills, projects that are underway at the moment? I think perhaps Joe we'll go back to you with this one. Couple that with how liquid our prosperity and how fits enable our prosperity to come through a situation like this. If there's no building going on for however long it takes, what sort of position a prosperity in to be able to weather that storm, and come out the other side, okay.
Yeah, sure. I think, building wise, we are currently still live across all of our developments.
Good.
There's a political challenge there, because the media has painted the picture that the sort of developers or construction is being driven by economic forces. I think it is, but certainly not driven by the developer. In most cases, it's well, in our case at least, we've allowed anyone that's on site to not work or work if they wish. The government's not shut down sites. I think the challenge will be materials over labour, because typical contractors, even from a main contractor, it will break down to subcontractors, and then within that, the bottom line is that the people actually doing the hands-on work are invariably self-employed, weekly paid in a lot of cases. That's always been the construction industry. So they'll work as long as they physically can. As a business, we've obviously taken note of all the legislation and the guidelines, and that's been enforced across the sites. I think we're still on site, so we're still live on every single site. So we're currently live on 5 sites currently, and they're a mix of PDR and new build. And then I think you can break them down into the 2 different sort of types of development. So PDR is a lot more simple, because PDR, office residential, an office conversion into residential, so it's permitted development rights is PDR, which we use as the terminology there. But whilst you're converting an existing building, bringing in the different disciplines is actually a lot easier, because ultimately there is you're not restricted by, in the same way on new build, where there is a process from start to finish. So admittedly, we can't do first fix or second fix electrics if we haven't got the walls up. Whereas on a PDR development, obviously you can bring in different disciplines in different orders, as long as you arrange it appropriately. It might not be perfect, and eventually it would slow down the overall delivery time, and possibly delay the ultimate delivery date. But still, PDR is easier to manage and remain on site, because you're bringing in the different disciplines in an organised way at different points. So you can do works where, if you've got electricians that still want to be on site and still want to work, they can come in slightly earlier than maybe they would have been scheduled. On the new build site, it's slightly more challenging, because again, that's probably, well, it is more labour intensive, and it's also more material intensive, because you've not got the structure of the building in place until it's up. So we were fortunate, both on PDR, we made large orders of materials 3 weeks ago. So a lot of our sites are storing a lot of excess materials. And then new build wise, we're currently live on Moseley Street in Birmingham. Unfortunately, again, we'd only just received our steel frame so we received around 75% of the cassettes that we need to construct the overall, 75% of the main frame. So that'll take us 6-7 weeks. So again, we're still on site there. As I say, politically, I know the media's kind of made it very much that it can be an economic driver, but that's driven by the contractors actually, rather than the developer. And then from Prosperity's perspective, we don't utilise debt on our PDR developments. So and that's something that we checked very easily from Land Registry. So there's no debt on our PDR schemes. So 4 out of our current sites, 4 out of our current 5 schemes are PDR sites where there's no debt on the building, and then we work through the.
And sorry, Joe. Which sites are those? Just so the clients that are listening.
We've got Sherwood.
Yeah.
We've got currently Sherwood,
H2,
and not live at the moment. Tail end of, well, we've just completed on Tameway,
yeah,
where we're doing handovers,
yeah.
and then we've got handovers at South End,
South side.
South side.
Right. Excellent. No
yeah,
worries.
those are the 5 current PDRs. We class 2 of them as kind of, 2 of them are still sort of live.
Sorry to put you on the spot.
That's all right. That's all right. Well, if you go on our website, you can see live pictures, and those are still being updated on our website across those 5 schemes. And then we've got the new build in Birmingham, which is Moseley Gardens. So across the board, PDR, we don't use external debt. So we're fortunate there. The buildings are bought outright, and then we work through the conversions. And then new build, there's obviously debt there, but then again, it's we work off a 60% gearing model. So again, there's our debt is low on the current new build. When you get into sort of some of the larger schemes, such as 1BHM, which is a kind of 226 unit scheme now, those come with with debt packages. But currently, we're not live on any larger schemes. Moseley Gardens is a 67 unit new build scheme, which is funded by PIP. BLG, which is part of the Pears family. They're experienced lenders, and it's very much on a drawdown basis. So we do X amount of work, and then we draw down against a valuation. So standard stuff. We're on site. The equity goes in first, so we have to get to a certain point. We've bought the site. We've worked it through planning. We then get on site, and then the construction debt comes in at the end. I.e., the construction debt is the final piece of debt that comes into the equation, and that takes you right the way through to delivery.
I think the important thing just to add in there is the financing facility is in place, so that there's a contract between the lender and ourselves to draw down as and when we require the funding. So,
okay.
Yeah. One final point on that, it's actually quite interesting that the the typical differentiation between the mortgage market, which kind of reacts very quickly. So the lenders currently are taking. They're reducing loan to values, and they're removing certain products from the market. Whereas the construction debt and the developer debt market is very strong. We're taking calls from debt lenders, in the market, and all the obvious names, from sort of the high street through to the more specialist lenders. But a lot of debt trying to get into residential property at the moment. So if you've got sort of existing schemes, some of the debt, the development debt market is actually tussling for position in relation. So we're getting calls where, if we've got schemes where we're trying to get on site, or they're mindful of the fact that, like all these things, if some schemes don't go ahead in the future, they're mindful to get debt into schemes because there's already a very competitive market to fund residential development schemes, and that's only increased. We've found over the last sort of 4 to 6 weeks. So there's certainly a lot of debt chasing UK residential developments, and they sort of see it as a strong place to be sort of positioning their book at the moment.
Great. Okay, that's positive then. So developments at the moment just continuing as planned, and sort of financially looking okay. I mean, that's probably one of the most common questions. What if you guys run out of cash? Is there any possibility that you would run out of cash and all bills grind to a halt? And then what happens to people? But it sounds like you're in a strong position, and obviously that's not happening. So that's hopefully that'll.
I think it's also worth just pointing out. And I know that we were limited on time, but it's how a construction debt is configured. So you don't go on site, without your funding package in place. So as David said, if we're on site. We're on site, and the ship's already sailed. So from a developer's perspective, he hands over the site physically to a contractor under a fixed price design and build contract. And then he also, the debt is in place at that point. So at the point where you've worked a scheme through planning, you're on site, all your equity's gone in. When you're actually on site, by the time the contractor's kind of underway, there's that ship's pretty much left you as a developer. Really, it goes into the hands of the contractor, and then you've got a senior debt line in place, other than the PDR, which again is just kind of is already pre-funded before. So we're never reliant on sales. Once we're on site, we're reliant on sales, as every business is, front end. But by the time we go on site, we don't go on site with an optimism to sell units. By the time we go on site, that development's completing, come what may. So there's from our side, once you're on site, there's a program. Yes, there's some flex in that program at the moment, but there's not a point where the development won't be finished. Due to if you're an organised, and sort of, if you're a developer that knows what you're doing at least.
Good stuff. Okay, excellent. Thanks for that. I think you touched on a couple of sites there, actually. Some of the the PDR, the conversion stuff, and some of the Birmingham stuff. But after COVID, and your financial security as prosperity, that's probably our second biggest question at the moment. Is can we just get some updates on specific sites and how this situation might relate to those? I mean, you've covered that off there, but
not far away. If you want to do an individual site, we can do it individually. If there's specific sites people have asked about.
Yeah, that would be good. So I think first of all, let's. I mean, I know you put it all up on the website, and people can see. They can go on there and check recent pictures and recent updates, all that sort of stuff. But it's always nice to hear it from you guys. You're in Birmingham and you're around the sites. Well, not at the moment, you're not, but you are when the office is open. So why don't we just crack on with the Birmingham sites as a starter, Joe? 1 BHM, B5, and you mentioned Moseley already. What's going on with those?
Okay, so we've currently got around 1,200 units, just over, within the planning spectrum or on site. So that's the Birmingham portfolio of sites. 1 BHM and B5, both of which were due to be at the April committee. So we were due hopefully for the 7th, if not the 26th originally. So those were the two planning committee dates within April. So we've got now two sites, both of those schemes are now awaiting consent. They're both supported by the council, which is a key part. So, and then obviously over the last 2 weeks, they've shut down the planning. They shut down the council offices in entirety, and then obviously on the back of that, the planning officers and the committee were unable to sit. It is a legal requirement for planning to continue in the UK. There was legislation granted last week of the first part of 2 parts of legislation. So the first part of the legislation to allow planning to commence remotely has already been passed. So now planning committees can sit remotely and make a decision on a consent. And then the second part will be around how the planning officers deal with any objectors. So what we don't want to do is for planning consents to, or anyone wants, is for planning consents to work their way through the system under the restrictions of COVID remotely, and then be challenged thereafter. So this second legislation will remove any challenges that could come in the future, and we expect that to be passed later this week. So our current timeline is expected timeline. We'll get to the end of this week. The second part of the legislation will be passed. Following week, the cities will then come to us, as well as anyone else that's got live applications, and then give us the format to how those planning committees will meet and proceed and function as best they can. So imagine that like all these things, there's it will be delayed, but hopefully ours by not too much, because we were on the register for hearing in April. So we would work on the basis that on that basis we were always set to be part of the next committee hearing on both sites. So although we can't guarantee that at the moment, if they can get themselves in a place where they can be mobilised to start working through consents within April, then there's no reason why we wouldn't get a consent on both schemes in April. The HM1 is now 226 unit, 24-storey development. That's what's going to committee with officers' support, and B5 is 116 units again with officers' support. So and I think that's where maybe some applications removed is where there are objectors, because what the city and what the planning committees won't want to do is to make any contentious decisions. So what they'll look to do is really just promote the sort of low-hanging fruit, really. So if you've got a well-packaged application where all the reports are there, and you've got officers' support, which is the key part of the equation that you need, where the officer that's actually looked after the case is actually supporting the case for approval. And there aren't any obvious objectors, and those are obviously the cases that they'll look to work through. So if there's any contentious consents, I think they might be challenged, but neither of ours are. So currently that's B5 and 1 BHM, very much sort of in spitting distance of being consented. BHM1's been a relatively simple journey because of the location. The city want to see a tall building there. It's going to be a landmark building in the city, so that's an exciting proposition, and we're certainly pleased with how that application's gone. B5's been a bit of a challenge, as clients may know, and that's really that was quite a technical consent. It's taken us over 2 years, and now we're glad to be at the latter stages of that. Moseley Street, as I say, we're on site. You can go on the website, or if anyone wants any live images, dated live images of activity on site, we can do that. Just touching on the point again on the where we talked about the debt perspective on PDR, that can be checked very easy from Land Registry. Or we can certainly, anything that we're talking about today can be validated document-wise if required. So any of the stuff we're talking about, I think is we can follow up with information following.
Fantastic. Okay, and Smithfield, have you got a quick overview on that you could give us as well?
Yeah. So Smithfield, a different animal, really. It's a 1.5 billion pound regeneration within the city centre core. So we have currently a pre-app in place. We've reduced the pre-app because across the overall site ownership that we have down there, there's an 855 unit application, which we took out, and then we put back in a 540 odd unit application, and that then takes into account the first 3 blocks, because the latter part of it, the schemes that we've not even drawn up yet, is where the access point, or one of the key access points into the scheme. So the key points around Smithfield, we've agreed with Lend-Lease that we are submitting a single application for the whole. So the single application will include residential, leisure, retail, commercial, communal space. So all the sort of the city's view of that sort of communal area, and the recreational space that will be the core of that, the festival square. That's now sort of well advanced, and then we're then bringing in the residential element, or part of the residential element. So we've had a lot of dialogue with Lend-Lease and Birmingham City Council of late. So the application was to start proper in May, and then that will then be worked through as a standalone single application, so a joint application between ourselves and Lend-Lease, presented to Birmingham City Council. Okay. So there's a lot of complexities around Smithfield, primarily, just to give you some headlines. One is access on the site and off the site, so the metro links that are key to the overall site will be the best connected location in the city, because it's got a map of metro crossovers across the site, as well as the access metros up to the HS2 station, and then there's also the taxation point. So when a scheme's got a lot of public realm, obviously there's a contribution point from all the profit making areas of the scheme. So the residential, commercial, retail will be funding the public realm areas. So a lot of that's still in negotiation, exactly who contributes what, and then those are the key points, really. So Smithfield, very much on, working our way through. Lend-Lease and ourselves, single application, but the key negotiation points at the moment is one, taxation on the the public realm, and 2, access on and off the site. And that will form the basis of those negotiations. Will form part of the overall application that we're working on now actively from May onwards.
Great. Thanks, Joe. We'll give you a bit of a break. You can talk for a while.
Callum, I could just add just a couple of things on each of those sites, which I know.
Fantastic. If you could.
Looking at some of the questions that you've had directly from people that I know, who are no doubt in the audience. In terms of just looking at 1BHM, whilst there's always been this great enthusiasm for us to produce 1BHM from the council, one of the things that has made the whole process much more lengthy than we ever expected is that our original submission was for a project which was a good degree smaller than the current one, and each time we've submitted a proposal, the council have come back to us saying, can you make it bigger? And this is quite unusual for us. Normally it's the other way around. So each time we've had to look at it and review the whole process and literally start again. And one of the key things they focused on is this marquee type of development with a tower on an already high area. So it's really going to be quite a dramatic project when it's finished. But it creates a huge amount of extra engineering requirements in the build. And that has taken us a lot of time, and made whilst there's an enthusiasm amongst all parties for it to happen, it's taken much longer than we originally expected, hence the delays. So on that one. On B5, whilst we don't have any more, there has been some contention around the local nightclub, as some people will know. But those have actually been resolved in the very recent past. So Joe's comment about the fact that neither of these are contentious is actually absolutely factual. We've resolved it after many months of contretemps with the nightclub owners. So that was the final tick in the box from our point of view. And then on Smithfield, I think you do have some investors who've bought at Smithfield. Smithfield is the most fantastic project, but it really is something that has been fundamentally delayed because of the magnitude of it. And I think it is important that everyone realizes that the prospect of delivering apartments within any of our Smithfield projects to them as completed units with these delays that we've encountered so far, I think we've got a better idea now of how long it will take, but we're going to be into 2022 before any of those units are delivered as completed articles.
Okay. Yeah. Thank you.
Is it worth just touching on just very briefly, just in case? Obviously, where David talks there about the fact that the city have been promoting a tall scheme on 1BHM. I just wonder whether some people in the audience might be questioning, as a developer, why you wouldn't want to just go as high and as big as you could, and why there was a resistance on our part. We try as a developer. You're always trying to increase height, increase massing, increase overall coverage to sort of maximise your sales values and maximise your saleable space. But there is a challenge when you get height, and height obviously comes at a cost, and then it's an exponential cost on a sort of floor by floor level.
Yeah.
But not only is it an exponential cost on the actual floor at the level that you are, but it also that then brings in an additional cost for every floor there are below. So to sort of there's optimum points within a building height from a build cost perspective. So when you see some of these schemes that are very, very tall schemes, kind of 40-story schemes, they're on a totally different funding model and proposition to the type of schemes that we're doing. So, a PRS scheme, which is a private rented sector scheme, would work off a kind of 15 to 20 year repayment model. where it's very much just a yield model. So they're building a product that ultimately is cost them more to build than it's physically worth at the time of delivery because of the height. And the reason why they would do that is because they're not anticipating selling it. They're only anticipating holding it and taking a yield from it. So their modelling is very different to ours. Whereas we're a developer that builds product and ultimately sells it. So we're mindful, one, of the cost to the client because obviously they're looking at yield performance. So we need to bring in units at a certain price point that where they can experience strong yields. And as you go higher and higher, there's a point where it becomes unviable to build based on current market values. So that was just thought it was worth mentioning that, really, just from the point of view of the challenges for us, and where the re-engineering that David talked about isn't just, you don't just stack units on top of units indefinitely. There are certain points within height that that generate huge amount of cost differences. So that was our negotiations with the council, where they might want to see a 40-storey building in that location, but a 40-storey building is not a building that you could sell for the next probably 10 years until the market catches up with it.
Sure.
We've had to engineer a building that was at the height that they wanted, but being mindful of the fact that it's still going to be a viable proposition to build it and sell it based on current market values.
Yeah, very interesting. I didn't know that about buildings getting a lot taller. Very interesting.
I can see some questions there on some of the PDR. Do you want to run through a couple of those as well?
Yeah, I was just going to say we've got a few people asking questions in our little question box, more specific questions about 1BHM. But what we'll do with those guys is we'll do those at the end, and perhaps we can do a one-to-one chat, because we've got a few more bits to get through.
Okay.
Yeah, just on the PDR stuff, we've got, perhaps David, you could do these for us. We've got H2, H1, what's going on with Cathedral, and then we've also got Parkview as well, which is not a PDR, but it's one we've not covered yet.
To pass it back to Joe, I think Joe's probably more hand on the tiller for those. I think the PDRs. He's more often in contact with the builders who are dealing with that one.
There we go.
You want to pick those off one by one?
Yeah, we'll start with H2 and H1.
Okay, so we're currently live on site on both. We're way ahead of ourselves on H1. We're actually about 6 months ahead of ourselves on H2. So again, the conversion work is a lot more simple. So you don't get any of the sort of delays in the ground. So you're very much going in, strip out, and then sort of doing your internal configurations and then sort of refitting. So we're still live, and I think at the moment, COVID or not COVID, they're probably both going to come in around 6 months ahead of schedule. So there's plenty of fat there on the delivery times. If we do deliver early, we give clients the option of completing early, but we obviously don't look to enforce that on the basis if they're on payment plans. Obviously, we'll run the agreed term, but certainly at the moment we're on target for both of those to be coming in around six months early, as well as Sherwood. If you look at Sherwood on the website as well, Sherwood's 2-phase PDR, 66 units across PDR and new build. We're 6+ months ahead there. So again, those were due for delivery in December. We're currently bringing them in from June for the front block, and then October for the back block, new build block.
Great, fantastic. Again, good news. Okay.
Parkview, I can do Parkview.
Hey, go on then. We will give you a break this time, Joe. Then we'll come back for Cathedral. But yeah, Parkview, Dave, fire away.
Parkview, again, we've had some planning issues which are very close to being resolved. So we would expect planning to come through in the next 3 or so months. Work has actually started on site, and again, you can access that information on the website if you go and have a look. But certainly, demolition of the existing buildings there, which were industrial, has commenced. In fact, I think it's completed now. So we're very much work in progress and just waiting the final sign off on the planning before commencing work, in 3 or 4 months' time.
Great, thank you. Okay, so I think last two, unless we've missed any, is Cathedral and Market Court. We've got quite a few clients here that have bought there. I appreciate that's still pretty early, but is there any update we can have on that as well?
Yeah, we're I think, well, at the moment, again, I know we keep referring to the website, but if there's any of this stuff that's not on the website, then it should be, and if it's not, then obviously I can provide some live photos from sort of on site if there's any purchases within any of those developments. But as I say, they all should be on the site. But yeah, Cathedral House, we're on site, ahead of schedule. I mean, obviously we're way off delivery, and I think, referring to David's point really, where some of these are on kind of 18 to 24 months delivery slots. This kind of 3-4 months of disruption, however long it takes. So from the point of view, I think we all take into account it should be relatively short, certainly over a kind of a 24-month build program terms. But we've done initial works at Cathedral House. It's ongoing. I don't think we're certainly not under any pressure there based on delivery slots of where we anticipate. So we're again relaxed on Cathedral House. So it's a relatively simple job. It's a small project for us. I think there was 7 units in that. 7 units maybe.
8, I think.
7, 8. Okay.
8.
So 8.
Type of thing.
Yeah. Yeah. So I mean, a very small scheme for us.
It's a lovely development. That.
It is. Yeah. No, it's a beautiful building, and it's it's one of those sort of sites that we that we'll do from time to time. So it's a small scheme for us. It's a sort of scheme, to be honest, that where we'd use it as a sort of to absorb manpower, i.e., there's 100 plus directly contracted within the construction arm, not on a subcontract basis across the sites at the moment. We've currently got about a 60%, 62% headcount as of yesterday. So there has been a tail off of some of the workforce, but there's about 60% still working. And we would in reality on the smaller schemes, we would use Cathedral House as a sort of to absorb manpower if they weren't on other jobs really, and then that's how it's programmed. So it's if we were to go in force, it's a sort of scheme that we'd probably do over sort of 3 to 4 months. So it's a sort of, and based on our payment plans, we'd work through it over the term really, as and when. Certainly at the moment, relaxed on it. Market Court's just popped up, so we're not currently on site on Market Court. We weren't due to be on site at with delivery still. Sort of 20 months away, I think, maybe 19 months away. It's a kind of 10-month build conversion program at Market Court, so that's programmed in to start in Q3, possibly sort of as late as Q4. So I think it's with your prelims in construction, you look to get on site when you're actually looking to, other than the smaller schemes, you're looking to get on site and hit it hard really. So we wouldn't we go in there as a in force and sort of look to convert that. But the works there is a kind of 10-month build. So we're in no way even due to be on site at Market Court yet. So we've done some initial strip outs and we've done some initial roof work and sort of external works. But there's no internal works going at the moment, and there won't be for a few months yet. So that's totally unaffected by current climate.
Brilliant. Okay, thank you. We have got one more. We've got 7 to cover, but let's come back to that at the end. We'll just get through the rest of our stuff quickly. We've got about 10-15 minutes.
7's a quick one if you want to do it now.
Okay, go on, fire away.
It's 7. We're due to be on site in May, so we've got we've extended the long lease with Birmingham City Council. So that was that was one of the things we needed to do before contracts were exchanged. So we're now sort of ready to go on from a legal perspective to offer contractual legal exchanges. Contracts is in place. So at the moment, no delays. I.e., we're due to be there in May. So if there are any delays around commencing build, then we can announce that at the time. But at the moment, we've got you've got to sign fully packaged, bonded, design and build contracts. So you know, that's due to be underway from May. Okay, so James and Claire Russell, thanks for your comments there. Yeah, I will. I'll follow that up this afternoon and just make sure that there is I make that an addition on the website.
Yeah. By way of explanation on that one, James and Claire, APW are one of our favoured brokers around the world, and they had exclusivity on this site. So, as Joe said, there's only there's certainly less than 10 units there. I think 8 or 9, and but it was only marketed through APW. So yes, it's
you didn't want to make other agents jealous.
In terms of being on the website, really.
But we can pop it on there.
It should be on there because it's actually a lovely site. So
it is lovely, yeah. But at least I think most of the people that bought there are actually listening, so that'll be good peace of mind for everyone. So thanks, guys.
And I think there's still one available, Callum, isn't there?
There is one available, yes. And if it's not snapped up sooner rather than later, I think I'll probably buy it myself because it's a lovely unit.
Well, we can see you afterwards if you like.
It's okay, right? Okay, gents, we'll just move into the last sort of section, and it was just about opportunities. You know, a lot of people are thinking, you know, now might be a good time to buy. Our price is going to fall so much that it represents a good buying opportunity. Will that happen? If it doesn't happen, still, where are the good places to buy? You know, is it still being driven by things like H2, you know, into Birmingham and further north and the East Midlands as well? And as well, you know, if people aren't looking to buy physical property, I think, David, this is probably more one for you. You know, what else can they do? You know, we've got some bond products or some loan note products that I think are quite popular at the moment with people. Could you perhaps give us a quick overview of those, and then we can go into, you know, locations and where you guys are going to be building next, and where you think the next good places to buy are?
Yeah, sure. So for those of you that aren't familiar with what a bond is, a bond is a way that a company, or indeed a country, raises some extra capital for the purposes that it trades from. Or for instance, maybe in the next 6 or 12 months, we'll probably get lots of gilt-edged stock being issued by governments to raise some extra money to help finance the enormous costs that they've incurred in mitigating tax for residents of the UK and funding the NHS. So it's a way of borrowing money in the open market, and a different fashion to just going to the main street banks or the specialist lenders. And from time to time, developers will get involved in raising money through bonds, very often with existing clients who are familiar with the company as well. And what we'll say is we'd like to raise an issue of, say, £2 million, and in order to provide some return on that for the investor, we'll provide what is called a coupon, an income, a yield, call it what you will, of 6, 7, 8% per annum, and then your capital back after the period. And usually, for prosperity anyway, usually the bonds are relatively short term in duration, you know, anything from 18 months to 36 months. And the reason that we need that money is really just to infill the difference between the senior debt that we raise, as Joe mentioned previously, which often amounts to around 60% of the overall project cost, and the amount of equity that we've put in ourselves. And it's a nice, simple way of raising extra money, involving our clients and investors in the journey a little bit more than they would otherwise be involved, and providing them with a coupon on that capital that would otherwise perhaps sit in a bank earning nothing in interest at the moment. The nature of bonds are very, very extreme, and the difference between a good bond and a bad bond is enormous. And I'm sure some of us will remember that the world stock market demise and crashes of 10 or 11 years ago were created by something called junk bonds. And the important thing when you're investing in a bond, in my view, are two things that you have to look at. One is the duration of the bond. So the shorter the term, the better for the investor, because at least you know that you're going to get your capital back in a short term, and it's more predictable what's going to happen over that short term. And then also the most important thing, the efficacy of the security around it. And the junk bonds back in the United States in 2008 and 2009 were providing 16% yields. And if you looked at the asset backing, it was smoke and mirrors. But people were buying it just to get the yield, not realizing that the asset backing was non-existent really, or could easily become non-existent. Our own bonds are almost always first charges on land that we bought at a very good price, that has had a lot of appreciation in value, will have more appreciation in value. So the securitization of your investment is really very solid as a result. And just as a general point, there are other developers offering bonds out in the marketplace, and some of them look really quite attractive, and you will get these higher coupons, higher yields. But I would urge you to all look at the efficacy of the contract and the security that's being offered, because oftentimes it isn't anywhere near as attractive as it is with us, and certainly not first charge. And there's the old adage, if it sounds too good to be true, it invariably is. And I think that's really well worth reminding yourself as you look at these offerings, particularly in difficult times like we're in at the moment.
Excellent, thank you. Yeah, no, just to add to that, I think that is a good point. It's important to look at the security behind these things, make sure you have got a first legal charge on them. That is very important. So, and I'd agree with you there. And I think people listening that have got these sorts of products would agree as well. So excellent, thanks. All right, cool. Thank you very much, David. I think we'll come on to our last little bit now, guys. David or Joe, whoever would like to start on this one, is just sort of opportunities. Have you got any new sites you'd like to talk about? If it's not still sub rosa, or are you looking at certain locations for building in the future, or even existing sites that you think are still great opportunities for people? What are you looking at, and what would you suggest for people that are perhaps trying to get into to buy to let?
Okay, so well, I think at the moment we've probably got the spectrum of units within their sort of build cycle. So we've got some final units at Tameway Plaza and Southside. They're build complete, so available for tenanting straight away. We're open to some offers on those if there's from a as we're now clearing the final units there. We've then got our current schemes, Market Court, Lombard House, which are our sort of traditional PDR conversions. Lombard's slightly, well, it's a smaller scheme, 22 units, and that's similar to the Cathedral House. So nice small scheme. And then Market Court is really sort of a regeneration play as Birkenhead becomes connected. Well, he's now connected into Liverpool with that sort of opportunity there with the Wirral, and then all the works that's the big regeneration play. So there's a huge amount of regeneration that's going to benefit from. So those are our sort of, so you've got build complete, you've got sort of 18 to 24 month delivery slots on PDR, and then I suppose the big push for us now will be getting on site on 1BHM and B5. So we're working with contractors, main contractors on both, to bring those schemes forward quickly. We've done a lot of work on the final design. So from a planning consent basis, planning consent ultimately gives is really just proving the principle. So it's the city saying, in principle, you can build a residential tower in that location of X amount of stories. That's obviously all the work that goes into placating them around sort of all the obvious things with transport, fire, noise, all the obvious things there that we work through. But then once you've got a planning consent, you have to work through the detailed design. So you're taking a plan then from off the page, consented, into an engineered form, and something that can be built. So we're currently working through that very hard at the moment, and we're not far off on either. So we're engrossed conversations with the main contractors that will do those builds. But the fundamentals of Birmingham haven't changed. The economy's growing rapidly. So we've seen 19+% growth rate over the last 5 years in Birmingham. The Birmingham City Master Plan, it was a 5-point plan, so it brought it really was born out of bringing employers to Birmingham. So we've become a kind of a service centre for the UK back office. So we brought a lot of professional services. So KPMG, Deutsche Bank, HSBC, huge head offices that have migrated either HQs to Birmingham or certainly brought the vast majority of their back office staff to Birmingham, service staff to Birmingham. So firstly, it was about bringing employment and creating that sort of sustainable employment base, so that that sort of demographic of people, working professionals in the city. Brought on the regeneration, and Birmingham really is renaissance period at the moment. So I think it's sort of been overlooked for a long time. But if anyone's been there, been in Birmingham of late, people come to visit us in our offices, and quite amazed by the transformation over the last sort of 10 years, and then what's to come. So we've now got Paradise, which is coming online over the next sort of couple of years, which is really the house. BHM1 is really to house those professionals that are going to be based in Paradise. So the business district now is has grown exponentially, and then you've got the connectivity point. So the old days, you'd turn up at Grand Central Station and have to kind of walk from one side of the city to another. You now turn up to Grand Central, which is our kind of new shiny train station. So I knew it's kind of 7 years into it now, but it's just had another part of the building extended, and then you come out of the station into the what in front of you is now the new metro connection system. So the first part of that was connecting up commercial district, and then they brought in the shopping retail area. And then they're now working their way down into what will be the southern gateway, which is going to be the housing district of the city, which is where Smithfield is. So I mean, across the board, we've got the Commonwealth coming in 2022. So there's loads going on in Birmingham. Still loads of potential there. Still we're seeing ongoing growth. That's our kind of big push to get on site on our two key schemes in Birmingham over the next sort of 12 months or so.
Great, thanks. And I think that's true. The fundamentals are very much still there. In these markets. I mean, there's a lot of negativity going around with all the news around the COVID, but I still think, and we believe, and I think you guys are probably of the same opinion, that there's still a lot to be positive about. With property in the UK at the moment. You look at the Bank of England rates at an all-time low, so that means mortgages are going to be a lot cheaper for people over the coming 6 months, 12 months. We've got stamp duties going up next year, so the next 12 months is a good opportunity to buy at a lower cost. And I think as well, there's a point this morning by Nationwide, they confirmed that house prices are actually up 3% the year to March, and that's the strongest growth in the UK property market since January 2018. So there's a lot to be positive about there. And they say that the COVID will cause a softening in the market short term, but after that, the underlying factors in the market will mean we're back to full strength. And we saw with the Boris Bounce, after Boris getting in, prices coming back and growing. So I think there is a lot to be positive about. So those people that are still listening, don't worry too much. There are lots of positive things going on, and there's still good developments you can get stuck into. Those would be the only things I'd add to what Joe said. David, have you got anything you'd add to that?
I think your catchphrase, the Boris Bounce, is quite a good one. But I think central government all over the world are, I think, apart from perhaps Korea, who seem to manage the whole thing really effectively, but and maybe Hong Kong and Singapore, but the central governments have, I think, underestimated the short-term effects of COVID, and I think hopefully history will show us, but I think maybe continental Europe has been, parts of continental Europe certainly have been very, very poor in that regard. And interestingly, I think the fact that we have exited the European market at this time might well play very well into Mr. Johnson's hands over the next few years. And of course, the irony is he did it without concluding a deal. And he might well have a justification now for going ahead and doing it without a deal, because the position over there could well be dire as Germany try to help bail out the countries like Portugal and Spain and Italy, who are undoubtedly in desperate straits, I think, financially, once this is all over. So I think that can only underline the strength of investing in the UK. I think that, you know, it's probably in the medium better than it's ever been. There's still a better legal efficacy here in terms of the structure of ownership than there is in any other part of the world, certainly the equal of all. And low interest rates.
Yeah, it makes a big difference.
Stable political background, and certainly still a currency advantage, which I can't believe will last forever. But I think that currency advantage at the moment still shows sterling being on its knees, although it's recovered a little bit in recent days. But that, I think, as it all engineers itself out in Europe, we'll see sterling improving very strongly there, and of course in the United States, who have their own very significant problems to deal with. So it's very interesting times, but times of change, I think, create opportunity, and I think you know, we're in, I think, residential property UK, it's a good place to be, and we've all got to invest our money somewhere. I think that's the final footnote.
Yeah.
So
thank you, and I would agree. You know, just touch on it again. You know, the fundamentals are there. It's everything's in place for good growth and a strong market. You know, so if we can get through the COVID situation, you know, then it'll be back to business as usual. Okay, thanks both. Thank you very much. We have got just one or two questions. There are a few.
To answer those if anyone wants to start.
Yeah, there are a few more, but they're specific to individual developments and people. So what we'll do with those is we'll send an email out with a video of this at the end, guys. And we can arrange a time tomorrow to speak one-to-one. We'll answer your questions via email as well. And if you want to speak one-to-one, we can do that.
We can do that over the weekend as well, Callum. It's all merges into one, really, where there isn't such a thing as a weekend anymore over here. So
it's quite nice speaking to different people, isn't it? You know, I was looking forward to this evening to actually speak to two people and see two new faces, you know, rather than my own in the mirror. So so yeah,
they're all there's some good questions there. So as I say, I'm happy to stay on and answer these, but it's up to you, obviously.
No, let's. I mean, I think just looking at the attendees, most of the people that are still logged in are the people whose questions these are. So yeah, let's just let's go through them. You know, we're not keeping anyone now. So
should we talk to Fergus Evans? Yeah, first.
Yep, for sure. Let's go.
So Fergus has asked a good question. Aren't they exposed to contractor going bust? So yeah, I mean, there's certainly you know, developers. You know, the whole market is exposed to the contractor potentially going bust. So I suppose it's to answer the question would be, you know, what can we do as a developer to protect that, to protect ourselves and protect you as the buyer, and it's really two key points. One is all the contracts are JCT, fixed priced, design and build contract. So that means that the contractor takes on the responsibility to deliver a scheme to a size, specification, price at a certain date. And then there are penalties if he doesn't deliver on any of those key elements. We obviously have a live view into, you know, the contractor's financial position as best we can, as best as anyone can. But the key to that is really from a contractual perspective. There are two key points that you must ensure that are in place. So one is step over rights, i.e. if a contractor goes bust, you're able to step over that contractor to bring in another contractor. And then you have a bonded contract in place, i.e. all of our JCT contracts are bonded. So we would have a fixed price, and then we would insure the differential should a secondary contractor be brought in to finish the work. So contractor A starts, he runs into trouble, falls over. At that point, if you're managing your projects properly and you've got the right QSs and you're experienced to know what should have been paid and what shouldn't have been paid, you've only paid as much of what you should have paid, i.e. for the work that's been delivered on site. So at any point, then you've got a step over right, which means that you can step over the first contractor with a secondary contractor, and then if there is a differential, which invariably there is, because a secondary contractor will always price an element of risk for the work that was done by the first contractor. The warranties are novated across, and then the work then continues with the second contractor, and the differential is collected by insurance. So if for example, we were £5 million into a £10 million construction contract and the contractor falls over, and the secondary contractor comes in and wants £6 million to finish the balance of the work, we would step over the first contractor, employ the secondary contractor, and then collect the differential through Aviva, which is our preferred insurer for insuring the differential and then the risk of a contractor going bust. And the market is for bonds is a good indicator of where the market is for contractor risk. We've not, at least, there's always a variance, but we've not seen any huge changes in the value and the cost of bonds in the immediate term. I'd imagine that's like anyone, they don't know the answer at the moment. So if they're underwriting bonds, they're unsure of the exact effects at the moment. But certainly, either way, we wouldn't start a contract without the right contract in place, which is a fixed price contract, and we wouldn't start a contract unless it was bonded, and Aviva's our preferred choice for that. So hopefully that answers the question for Fergus.
Good question as well.
Yeah, for sure. Okay. Do the new units in 1BHM need to be sold before the building can start? I hear we're going through a bunch of approvals. Okay, so yeah, we are going through approval process. That will be resolved within the next sort of 6 weeks, but that will be the final approval, which will get us, on site and know the units. I mean, every developer, every business needs sales, but as we talked about earlier, we would have a funding package in place that was a standalone package. So yes, we would need sales, but as a pre-sale model, that's our choice, i.e. we choose to pre-sell, but like a lot of the PLCs, for example, they would choose to sell in the open market. So we take a different approach, but there's nothing stopping us ultimately delivering units and selling them at completion if they weren't all sold. But typically we've sold around 85% of our units before we're on site. That's just our typical model.
Great.
For 1BHM, back to Fergus, if planning's changed so much, what happens to the units we have booked? So the difference there's very little difference in the units that you'd have booked, and I say that confidently on the basis that although the scheme's changed, it's actually changed in height, i.e. If you were on the 10th floor with a one bed looking a certain direction of a certain size, that will still be in place, but obviously we've just gone higher. So the floor plates have not changed awfully, but any very minor changes to floor plates. We've just stacked them higher, and then had to re-engineer the foundations and the groundworks to accommodate the height. Let's have a look.
And I would say that now being more of a landmark building is probably going to make it a more attractive place to buy and a more attractive place to live. So I think longer term and from a rental perspective, it's now going to be even more attractive than it was. So I think all round it's a positive thing that the units have been added and floors added.
And if I can just add, Fergus, nice to have you with us. Long time no speak, but hope all's okay. In terms of this, the process as well is those people who have reserved early or in advance undoubtedly get priority over the new project or the refined project. So As soon as we get planning signed off, then those people will all be contacted individually and their own circumstances discussed on a one-on-one basis to find the best solution for them. So, for instance, one question that has been asked, not on this site but on another one, is, well, if I bought the apartment on the 13th floor of a 13-story building and it's now a 17-story building, do I still get a 13-story building? And of course, no, we will do all that we possibly can to accommodate the wishes of the person who invested early. And if they invested to buy a unit on the top floor, then a top floor they will have. So it will be a top floor of the enlarged or heightened building. So hopefully that just helps that from a clarity point of view as well.
I mean, if you look at any sales that we've done, I mean, we did a short release on one BHM, and then quite quickly sold sort of 60, 70 units, and the values there that are obviously locked in for those buyers at one BHM, significantly lower than the consented values will be. So somewhere in the region of, they were kind of mid 300s. And then the consented value price based on where the market is currently, and obviously the building being the kind of iconic building that it will be in the city, certainly in excess of £400 a square foot. So anyone that's in now is in a very good position for sure. Next question. Let's have a look. This is from Rick. Let's have a look. There we go. We were told that the repayment period will be extended as the rent received didn't match up to the predicted amount. Given the COVID-19 relations, is this still guaranteed? I think I understand the question. So if you're currently purchasing, are you able to just tell me, Rick, the site that you're currently on at the moment?
I think on that one, Joe, it's on the builder's loan, no mortgage stuff, those developments. If COVID-19 means that people can't pay their rent on time, who does the onus to cover that for to? Does it just mean that the repayment period for the loan to you is extended, or does it mean that Rick would have to pay it?
Sure, sorry. Any of our VPP products, which is where, as a developer, we've funded the client for a balance rather than them taking out a mortgage. So that's a one-way street, i.e. once we've funded, there is no payment to Prosperity from the client. So the only flex there is the term. So if there's any tenants that aren't paying their rent, we are absorbing that. At the moment, there are actually few. I think that the government have put things in place whereby the majority of people, if they're not working, have got sort of 80% of their sort of salary coming in, or employers have sort of kept them on a reduced time basis. But I think that so we're not seeing a huge tail off in rental income against that VPP book, which is all ultimately deferred profits and deferred income to the business. So we're not seeing a huge tail off, but the only flex in that is just the term. So if we're not paid for 3 months, and the other difference is the government's not said, and certainly there's no tenants that are just getting free rent. Rent is to be paid. They've given them a 3-month holiday, so that then, and the argument there is that ultimately at the end of it, that rent's still got to be paid, so it will just be on a payment plan. So we would agree with any tenant that was calling us to defer rentals that they can certainly defer rentals to get through the next 3 months, but then after that, they would have to make good on it. So it doesn't actually affect the term, because it's a 3-month holiday. Those monies will still be collected, and from our side, there is no payment to be made to us from a property owner perspective. So I hope that covers it.
Okay, cool. Thank you. I think we've put a Smithfield Square question there. We've covered that off. I'm not entirely sure if my interpretation of this question is correct, but mortgage lenders in the UK can defer mortgage repayments will Prosperity be doing anything similar if we get into financial difficulties? So my interpretation there is, if people are struggling to pay their monthlies, if they're purchasing a property, you know, off plan from you guys over 24 months and they're struggling, is there any, it's probably not the question to ask you, Joe, because obviously you want to be getting cash into the door for the business, but is there any leeway there for people, say, that are out of a job or that are struggling to pay those?
I think, yeah. I mean, across our portfolio of income streams, I mean, VPP that we've just touched on is one. So that's really, you know, we've got a balance of deferred income to come from rental that we're collecting. So we collect currently just over £1 million a year. In fact, it's around 1.5 million now, actually. Around 1.5 million pound a year in rental receipts that is deferred income to us, where we've self-funded the client on a BPP balance. Again, there we've just touched on that one. Commercial property that we own as a portfolio, we're negotiating with landlords. Again, we've not seen, you know, huge tails off there, but some of our landlords are paying us kind of 50% over the next 3 months, and then making good come the end of the year. And then obviously clients that are paying deposits, you know, that, you know, they should just talk to us, and you know, but it's best to have a conversation, really, so at least we can understand, you know, if there are going to be delays in payments, and agree a payment plan. So, but yeah, you know, you know, clients interacting with Prosperity, you know, in different forms, should just talk to us if there's financial difficulties to you know, so we can agree a payment plan.
Thanks for that, Joe. And yeah, I would just back that up. You know, I know we spoke yesterday about it, didn't we? We had a client up in Hong Kong that wants to try and reduce things for a little while. And, you know, if there's any non-clients listening and new people listening, and yeah, it's one of the great things about working with Joe and David is, you know, you can speak to them directly, and, you know, you can talk about these sorts of things, which you don't necessarily get when you're buying from a Barratt Homes or a huge nationwide developer. So that's good. Are there any other questions in there? I think we've covered off most of those other ones. Any others there, Joe, you can see that you'd like to go through, or you okay?
I think the only two that are showing currently are from Rick, which I understand we've covered. If there's anything missing that we haven't covered, Rick, if you'd like to type it in now, and then we can. But if you're still on and listening, hopefully we've covered that. Give them a minute to follow up on that, and then I think we've answered every question there. Great.
Well, I think guys, for a second experience at the whole webinar thing, I think that went very well. You know, thanks very much for giving us your time this morning, for you guys and everyone that's listened, whether it's been morning, afternoon, or evening. You know, thanks for listening. We'll be back again. Oh, from Rick Blackie, that's okay. Great, thanks, Rick.
Good. Okay.
Excellent. Yeah, okay, guys, we'll leave it there. We'll be back again next Thursday with another talk with some more people. But Joe, David, thank you very much. We will appreciate that.
Welcome. Thanks everyone for joining us.
Thank you. Goodbye.
Bye-bye.